Rahul Arora is with us, CEO at Ashika Institutional Equities. Rahul, good morning, and I guess I should say congratulations are in order. After a long stint at Nirmal Bang, you've moved on to Ashika. So wish you all the best of luck. Markets, of course, have started 26 on pretty much a frenzied note, at least globally. Here it's been more slow, not so slow in the last 7 days with India, US, and all these other things which have come in. But what's your sense, Rahul, the broader, sort of bigger view for markets from here on?
Good morning, Prashant. Thank you for having me on and appreciate the wishes. Thank you so much for that. So I think, Prashant, if you look at it, see, at the end of the day, liquidity drives markets. We have domestic liquidity and you have foreign liquidity. Now, let's look at FY27 as a case point. We're expecting consensus earnings are at about 12-13%. So if I'm an FII looking into India at that 12-13%, I'm starting off minus 3-4% on currency depreciation any which ways. I think the fisc has been projected at 4.3% for next year. And the tax projections are a bit somber as well. So there will be a slight concern on that rupee depreciation at the back of the foreigner's mind. Add to that about 12.5% LTCG and maybe 1.5-2% inflation in their country. You're basically talking about if you're expecting the market returns to be same as earnings growth at 12-13%, you're talking about post these adjustments about 5.5-6%. I'm getting the US 10-year at about 4.5%, which is a very safe asset. So just for 100 basis points, why take the trouble in investing in a market like India? So that could be one school of thought as to why it's been so difficult for India to attract FI flows for quite some time. And that same logic, Prashant, would hold for DIIs because you just replace the rupee depreciation by your domestic inflation. And then you have fixed deposit rates at about 7%. Most of the people would be taxed at about 20%. So you're talking about 5.6% post-tax on a fixed deposit. Again, for 100-150 basis points, the spread is not that much. So I think, Prashant, for a convincing case for the markets to make a new high and sustain that, we need to get into a situation where the expected returns of the markets are at least 20%. And that probably won't happen unless you're going into a fiscal year with 16-18% kind of earnings growth projections, which I still think we're a little way of a distance away from. So I think that volatility that you spoke about with respect to the STT announcement and then the trade deal positive, I think that's behind us. We're looking ahead to earnings now. In a couple of months, we'll start looking to the heavens for projections on the rains and see how that goes. But I would think that this would be another year of consolidation, Prashant. It could be a very tough year. You could see the Nifty consolidate, say, between 24.5 to 27.5. That's not to say you won't make money, but it'll just be another very challenging year because both domestics and FIs have other asset class allocations. And I don't for a minute buy the theory that people are going to stop investing in gold and silver because of what's happened in the last month and a half. I think those are still very viable alternate asset classes.
Okay. All right. Hi, Rahul. Good morning. Good to see you in and all the best in your new role. Seen you going from strength to strength over the years. And I only wish you the best, Rahul. And we look forward to interacting you more often as well. Since you mentioned gold and silver, let's talk about Titan. We'll be having the management shortly who will be joining in on the show. What do you make of the numbers? Expected to be good. They were pretty good as well. So if you want to give us your take.
No, so thank you for your wishes, Nigel. So I think I've been a believer in Titan for a very, very long time. I mean, we've spoken over the years. See, these kind of stocks won't come cheap, Nigel, when you're talking about 10-11% kind of growth rate, which is very, very difficult for consumer staples to give you at this point in time. I'm sure you've looked at the numbers for most of the consumer staples numbers that have come out so far, barring the foods. If you keep Britannia, Tata Consumer and Nestle aside, the rest are all giving you between 3-5% kind of volume growth. So I think in that backdrop, if you have a Titan that's giving you strong double-digit growth, I don't see why you wouldn't want that to be part of your portfolio. Of course, valuations will never be cheap, but I think it's not just Titan. Nigel, I would sort of take that discussion further to other consumer discretionary names as well. I'd still be a believer in names like UNSP. United Breweries, I think today should react very well to its numbers. It was a very, very strong set of numbers overnight. Hotel stocks have been doing extremely well. You're looking at 8-9% kind of growth in ARRs. Occupancies are holding in that 65 to 75% range, depending on which hotel you pick up. So I think Titan, liquor stocks, hotel stocks, aviation stocks would be the preferred names because you're struggling to get volume growth in frontline staples. And there as well, I think if you look at most consumer staples, bar Emami and ITC, they're still trading at between 43 to 50 times on a one-year forward basis. So if I'm getting a 10-12% kind of growth or even higher than that in Titan, for me, it's a no-brainer to be adding it at any corrections, if at all you get them.
Do you think QSR is going to make a comeback in a more durable way this time? Jubilant FoodWorks say like-for-like growth was about 5%. Is that good enough? And we've seen so much consolidation in this space, Rahul.
So, Rima, when Swiggy and Zomato came out, I actually thought these would be enablers for the business. They've actually turned out to be disruptors for the business. Now, I know there was a day last week where you had all the QSR stocks up between 5 to 15%. But we have to keep in mind that a lot of these bases, barring Jubilant FoodWorks, are coming off the same-store sales growth that you saw for this quarter are coming off very low bases. In fact, Jubilant was the other way around. It came off an 11% like-for-like growth, and that has tapered down into the low single digits. So I personally think, Rima, I mean, if you look at a McDonald's, for example, you have the most expensive item there is your chicken Maharaja Mac, which is 250 rupees. If you look at a pizza, decent size, you're talking about 500 rupees at least for a chicken pizza. Now look at the options that Swiggy and Zomato have given you in those price ranges across cuisines, not just Indian and more. So I think there is a challenge. The other thing, especially for dine-in QSRs like Burger King, McDonald's, etc., is that barring the last 6 months, movies have been very soft in India. So the footfalls into the malls haven't been that good, which hasn't translated that much into growth. So Jubilant is still coming to you at 65, 70 PE. McDonald's is close to about 100 PE. A lot of these have assets, in countries like Indonesia, Sri Lanka, Turkey, where things could go wrong at the whim, and we won't even know it. It'll just show up in the earnings. We'll be talking all about it, but it may just surprise us on the negative side. So I would stay clear. As I was telling Nigel a while earlier, if I have to play food, I would probably still play through names like Britannia, Tata Consumer, and Nestle. I still think the times ahead could be relatively challenging, both from a growth as well as from a valuation standpoint for the QSR sector.
Okay, all right, Rahul. Time for a beer, a pizza, or whatever you choose. Thanks a lot for joining in. Catch you soon.
He goes for expensive things, right? Like Titan, beer. He's not going for the 200 rupee Maharaja Mac.
Okay.
It's a premium play.
Rahul, you know what's on demand then.
Let's hope my bonuses continue.
Catch you soon.
Talk about that, but thank you so much, Nigel.
Okay. Catch you soon for the pizza or the burger. That's on me. The other expensive stuff on you. All right.